Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, 10th November, 2023, and joining Derek to pose some questions on the financial market themes for the week ahead is Michael Owen, Head of Global Client Desk EMEA. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Good afternoon, Derek.
Good afternoon, Michael.
A week ago, the dollar had a bad week after the FOMC and the non-farm payrolls, and it looks set to fall further. But a week later, and here we are, and the dollar is strong against nearly all G10 currencies. I guess the talk of the turn in the dollar was perhaps a little premature. Is that your take as well, Derek? And what helped the dollar to rebound this week?
Thanks, Michael. Yeah, definitely a week ago, things looked quite different. We certainly thought there was scope for the move to be extended. But as you mentioned, that hasn't really happened. The Swedish krona is just about unchanged on the weeks against the dollar. So in other words, the stocky has performed as well as the US dollar pretty much against the rest of G10. There was nothing really specific there. Perhaps, the Riksbank is conducting its hedging program that essentially means selling foreign currency, buying stocky. So that may have been a feature in the flows this week that made it a more dominant aspect than in other weeks, and that's kind of helped stocky to hold up. There was certainly nothing fundamental for stocky to have performed as well as it did relative to the rest of G10. But outside of that, yeah, like the European currencies held up better. Euro, Swiss franc were the other best performing currencies in G10. And then you had the kind of global growth, high beta currencies. Aussie and Kiwi were the worst performing, and then the Japanese yen in behind. Again, there was nothing clear cut in terms of a specific feature for dollar strength. Maybe just the sell off last week was overdone, and there was scope for some rebound. We did see the commodity price space. Certainly, we saw some pretty notable declines. The Bloomberg Commodity Index is down nearly 2.5% this week. So that may help to explain, for example, Aussie and Kiwi. Also, we had the RBA meeting. While they did raise rates, there was a dovish guidance in terms of the potential for the RBA being more comfortable to stay on hold. So we did see a drop in yields, although some of that has been reversed today on the back of the monetary policy statement, which saw some upward revisions to inflation and growth. But overall, I think the commodity price drop is certainly something that has been supportive for the US dollar more generally. And then I think towards the tail end of this week, we've had some factors. Obviously, the 30-year auction, we had a very bad auction yesterday. The tail on the yield was 5 basis points relative to where we were trading before the auction. And that was the worst result on that measure. Well, actually, the second worst, I think, in the last 10 years. So pretty poor 30-year auction, and that resulted in a pretty sharp rebound in yields. And then some comments from Powell as well, suggesting that the Fed are not entirely confident that they've done enough in terms of the monetary tightening, which, again, it's I think the Fed are always going to leave open the potential for more rate hikes. So, yeah, it's kind of a mishmash of factors. Nothing really stand out, if you like, but it has resulted in as you said, a kind of a broader recovery for the dollar. To me, I think if I was to make kind of one key point here in terms of the dollar view going forward, we do think the dollar can weaken, but we do have quite relatively cautious forecasts for the extent of weakness in the first half of next year. And that's partly down to the fact that, for the dollar to really sustain dollar selling and to depreciate, on a trend basis, if you like, you need to have, pretty decent global growth backdrop. Because obviously if you're selling the dollar, what are you going to buy? And if you have strong global growth, or even just a pickup in global growth, you have more options for buying currencies versus the US dollar. And I think maybe this week is a kind of an illustration of the inability of the dollar to weaken on a sustained basis, given the very fragile global growth backdrop that we have at the moment. And I think that, to me, is as good an explanation for the recovery of the dollar this week. Now, we did have some upward divisions from the IMF in terms of growth from China, but generally speaking, the data in the UK, the data from Europe, it's still not particularly pretty, and it certainly continues to point to relatively flat growth over the next 12 months. And in that sense, while we think the dollar can weaken, the scope for dollar weakness is still relatively contained because of that weak global growth backdrop.
Thank you very much, Derek. And looking forward to next week, obviously US CPI is the big one, but what else should we be looking out for next week that might be a key driver in FX?
And going back to the first question, another reason perhaps for the inability of the dollar to continue to sell off was just, maybe there was some appetite for position squaring, because obviously next week that is the big event from the US, and that will certainly shape yield direction and therefore the dollar more generally. Outside of that, I think it's probably the UK is where we would definitely focus on. It's where you've got some pretty important data. I mentioned a moment ago weak UK data. So we had GDP today, which relative to expectations was a little bit better than expected. But when you look at the breakdown of the GDP today from the UK, a lot of the upside surprise, if you like, was external demand related, and that's not something you can be dependent on. So the other factors were all pretty weak, and it does point to continued weakness going forward. But next week we've got the CPI data, and we've also got the jobs data. So the employment data in the UK is definitely becoming a little bit more interesting in potentially indicating a turning point. So we've already had three consecutive months of declines in the PAYE employment data. So that's a month ahead of the ILO data. And the consensus for the PAYE employment figure is for October is for a drop of 20,000. So that would be the fourth consecutive decline in the PAYE employment figures. So, that's the first time since COVID, and it would certainly be indicative of a clear weakening in labour demand. And the median pay within that PAYE data is definitely beginning to slow. So the annual rate is at 5.7% as of September, but we've looked at the 6-month annualized rate, and that's at 4.2%. So the momentum is clearly to the downside, and this is a month ahead of other data. So I would certainly expect to start seeing in the other wage data a clear kind of sign of deceleration. We also had the Recruitment and Employment Confederation figures. That's another survey, labour market survey, and it showed the 8th consecutive month of increased supply of labour, and that has resulted in starting salaries falling to a 31-month low. So there's building evidence that the labour market is softening, and I think when we look at the comments from Hugh Pill, the chief economist at the BOE this week, he was comfortable enough to acknowledge that a rate cut by the middle of next year was not unreasonable. And that's maybe not a big statement for most people to make, but for the chief economist from the Bank of England, he knew exactly what that would entail in terms of feeding expectations. And I think the bank are definitely becoming more comfortable with the idea that they're done, and that the next move is going to be to the downside. And then, of course, the CPI is going to drop dramatically. So there's a a 2 percentage point drop in the annual rate from 6.7 to 4.7. A lot of that is down to the base effect from the Ofgem price cap increase for utility bills that took place in October of 2022. That was an 80% increase, and that will drop out of the annual calculations in the data that we get next week. So that's the big reason for the drop in the headline. The core obviously won't drop to anything like that, but we should still see some declines in the core rate. I think 6.1 down to 5.7% is the consensus. But all in all, I'd probably put more importance on the labour market data in terms of the Bank of England's thinking of where inflation is going to be in 6 months' time. And if we get further evidence of labour market weakness, I think it'll certainly reinforce the prospects of a rate cut from the BOE by the middle of next year. And there's about 60 basis points priced by the end of the year. That's less than in Europe or in the US. So I think there's more that can be priced in if the markets become more confident on a rate cut, and as more is priced in for the latter or the second half of next year, I think that can certainly result in sterling underperformance, maybe better reflected in euro sterling going higher rather than cable going lower because of our dollar view.
Then finally, Derek, on the trade idea section of the FX Weekly, I know you were looking at potentially doing a short dollar position. So could you just update the listeners on your current views, please?
Yeah, we put on two short US dollar positions. So one against the Swedish krona and one against the Mexican peso. As you might guess, the Mexican peso was the riskier of those two trade ideas, and unfortunately that swung back the other way. I mentioned the poor 30-year US Treasury bond auction, and the dollar bounced on the back of that, and that hit our stop level. So we've closed that one out, but we're still in the dollar stocky short. I mentioned the Swedish krona being the top performing currency this week, so that's worked well for us in terms of being long stocky. Obviously the dollar's come back more generally this week, but we'd still at this point in time have a preference for being short the dollar. Obviously, as we've said, next week's important in terms of the US inflation print, but certainly the headline inflation print should drop. I just think in general we're going in the direction of weaker data, lower inflation, and better prospects that the Fed are done and that they can start cutting rates sooner than elsewhere, and that ultimately leads us to favor short dollar. And for now we'll keep that short dollar stocky position. If the dollar does start to re-weaken again next week, we'll probably look to add another short dollar trade at the end of next week.
Thank you very much, Derek, and wishing everyone a good week ahead.
Thanks, Michael, and you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.